This week in the boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partners, the Center for Audit Quality, and Grant Thornton, and contributing partners, National Investor Relations Institute, and the Society of Corporate Secretaries and Governance Professionals.
Welcome to this edition of This Week in the Boardroom. I'm TK Kerstetter with Corporate Board Member, and it's my pleasure to welcome you to a show that we're going to take a look at sort of Davos Revisited and the World Economic Forum, and particularly we're going to look at the global financial recap, sort of take a look back. And Scott, you had the benefit of being there, and let me introduce Scott as my co-host and today as a guest. And he had a chance to be at the World Economic Forum, and as you saw on last show, reported from there. And also joining me is Nichole Jordan, who is the National Banking and Securities Industry Leader with Grant Thornton LLP. Welcome, Nichole.
Thank you.
And Scott, what I wanted to do is, you know, the global financial environment is such an important piece of Davos because everybody's looking at how we're going to fund and how economic policy, and we have Eurozone, and we have all the issues that I'm sure were a big issue out of there. So from you, I'd sort of like to get the overall tone. You know, when you were there, I know it's always very busy and it's hard to do, but when you're there and you look at, you know, what people are talking about it's going to take for banks to be successful, and we look at a lot of the participants there wanted central banks to sort of, you know, let the economy go a little bit, you know, let rates rise, you know, because they're worried that decisions in the short term are going to affect the viability in the long term. But just talk a little bit about the overall tone as it related to global finance.
Sure. Well, as I talked about live with Ian from Davos, there was a subdued optimism that I hadn't seen in the previous 5 years, the 5 years that I had been in attendance, and certainly in a post-financial crisis world, a much less focus on the stability of the banking system, whether or not Europe was going to tumble into chaos, which was the discussion last year. And I think this year it was really looking at global growth, which is projected to be around 3% in the context of regional activity. And so a lot of discussion and focus around what's happening in the East, particularly in China, what is happening in terms of political and real destabilization in the Middle East, and certainly in that context where you have businesses that are operating there, a tremendous amount of exposure with the deep destabilization in the Middle East, and then really finally a focus on a muddling Europe. And I say muddling Europe because I think there's a view that certainly Europe isn't something where we're seeing a lot of destabilization. But one number that particularly stuck out for me was in Angela Merkel's comments, where she gave three numbers: 8, 25, and 50. Europe represents 8% of the global population, 25% of global GDP, and 50% of global entitlement spending, which puts the Europe challenge in context and also tells you that you've got years that it's going to take to work through some of these issues. The last point I would make is really about the U.S. There was a very optimistic view about the U.S. in terms of it really being a new growth cycle. And certainly there's also a view that the regulatory constraints take out maybe 1% out of that GDP growth, but the U.S. as a whole was a very optimistic view. The only other point that I would make, and again, it's more in putting these things in a global economic context, we had a dinner with Christine Lagarde, and she focused a lot of her comments around gender equality. And again, throwing out a couple of numbers that I thought why this was important. 85% of consumer goods are purchased by women. 50% of autos are purchased by women. 60% of electronics and technology are purchased by women. And so putting gender in a global context and an economic context is extremely important as companies and as leaders are looking at how the world is evolving. And that was a big takeaway for me as well.
It is true. Jamie Dimon, who was sort of there representing the U.S. banks, even though they took obviously the big trading hit, he was very bullish, on what could happen. So the U.S., I think, is hopefully leading the way here on that. So Nichole, one of the things that was interesting in Davos was the discussion about in the financial industry risk and capital. Okay, and there were a lot of questions about who was going to fund sort of the infrastructure going forward when they, through regulation, almost make it restrictive for banks to do, and are now making it restrictive for insurance companies to do. So the two main sources of funding the future are sort of, under attack, if you will, and so there's concern about that. And then we see all this stuff being thrown around that maybe the average director isn't aware of. Basel III, Solvency II, QE3, all these issues that relate to capital. Can you sort of clarify that and just talk about what your issues are relative to risk and capital?
Sure. I think a lot of good discussion around these increased capital requirements, whether it's the Basel framework, Solvency, QE3, and how that would impact the overall financial structure. A lot of discussion about how that would impact the recovery, and is that slowing the recovery from the financial crisis. But I think that, in our view, there certainly will be an impact on GDP growth from these increased capital requirements. And I think that, many estimates would indicate that banks would ultimately end up increasing their lending spreads from anywhere from 15 to 50 basis points in order to kind of account for these increased capital requirements. And so at the end of the day, this will have an overall impact on the economy and on the growth of GDP.
Is there still the frustration with U.S. banks, and not so much maybe on the high end, but in the mid-cap and small, with regulation sort of hamstringing them a little bit in the lending area?
I think so. I definitely think that they're trying to get ahead. Number one is trying to get an understanding of the complexity of the increased capital requirements and all that is mandated today or that is in the pipeline. I mean, many of these rules have not been finalized at this point. So I think it's trying to get the structure in place in order to understand the rules and then be able to put the process in place to ensure the best practices for meeting the capital requirements. And ultimately, as I just mentioned, we know that that will have the impact on lending in one way or another.
Yeah. What's interesting to me that I didn't think would be a part of the forum, but ended up being a part of the forum, is this issue of shadow banking, where as the banks are restricted, it creates opportunity for other companies to come in, and they have. Hedge funds, the Walmarts of the world. Shadow banking refers to this issue of non-traditional banks getting into this business. Now, none of them are regulated very well, and not like their brethren, which are the traditional banks. So, first of all, should it be? Okay. Some of them have risks, some of them don't have risks. So how does shadow banking shake out when the traditional banks are under such regulatory pressure that it's almost greasing the skids for other people to get into the business?
Definitely. I think there should be a regulatory support framework for both the traditional banks and the shadow banking system. I mean, clearly there is a need for the shadow banking system, and that's why it exists today. It is meeting that demand. But I think there is a concern about the regulation and the perceived risk associated with the shadow banking system. So we do need a form of regulatory support structure in order to support the system, whether it's in, probably primarily focused on the capital and liquidity support structure that we have with the banking system today, with the FDIC insurance, with the Fed discount window, the support structure that is there for capital and liquidity, and ensuring that we have that basic framework in place for the shadow banking system as well. Because I think you see an increase in that area just as the gap continues to increase with the regulatory requirements on the banking environment compared to the non-traditional banking environment or this shadow banking system. You will continue to see an increase there as you see the gap widen for the increased regulatory requirements.
It seems like human nature, though. If you enter the business and you enter it at that level, you will quickly find out where the profitability is, and you
Right.
will expand your reach just like normal companies would. That's I guess the biggest fear I would have, that somebody says, yeah, this is all we're going to do, but you get into the business, you find out you have certain expertise, and all of a sudden you're in the more risky parts of the business, and then it does need to be regulated.
Right.
You made a good point, though. There is a huge demand for liquidity in the financial system. It's building out infrastructure, it's investing in new platforms, investing in new R&D that requires capital, and the capital needs for a lot of the emerging growth companies are significant. And the challenge with the regulatory system that we have had is that many of the banks, coming from a view a few years ago of being vilified and now capital constrained, that hasn't eliminated the fact that we need capital to be able to grow as a global economy. And so it's also true that capital will find its most efficient use. And so I don't like the word shadow banking, really, but I really look at it from a capital efficiency perspective. There will be vehicles, there will be funds, there will be ways in which projects will get funded. And I think regulators just have to be very focused on that balance between regulation, which can cause a constraint on growth, versus sort of less regulation, which allows more flexibility and the ability to invest in the growing areas of the economy. And I think we're now at that place where those discussions are happening, and that's somewhat of a pendulum shift from where we've been, which is vilification, don't lend, don't do anything risky, to, okay, we need to start moving things along the risk curve a little bit so that we can start providing a flywheel to the economy.
Yeah. Well, as a former community banker, the mid-caps and the small caps really didn't do much to contribute to the crisis, yet have paid a heavy, heavy price in the fact that they have so much regulation that they're just not able to compete like they should be able to compete. And if you want to revive the economy, we're talking about probably 4,000 banks, that can start lending into building the economy. And right now, it's just way out of balance. And so if there's anybody, I probably feel for, the mid-cap and the small-cap financial institutions.
Agreed.
So part of our quest here is to make sure that we pass along information that's important to the board members. So I want to ask you both a question of, we've been through this year's World Economic Forum, and there's information that came out relative to the global finance. What should the day-to-day director of a public company garner out of the World Economic Forum that should help impact their strategic plans or their steps that they're going to take to be successful in 2013? What would you say? And Nichole, I'll start with you and then go to Scott.
Sure. I think there are many great themes coming out of the World Economic Forum that directors can use in implementing their strategies today, or helping management think through in their strategies today. Number one is just helping them think through the new normal operating environment that we're in on a global basis, on a domestic basis. Secondly is the mindset of addressing the new wave of regulatory environment that we're in, the new wave of regulations coming, and creating a culture of compliance and risk management from the very top of the organization. I think other areas relate to just being able to manage through crisis, whether it is the known or the unknown. There was a lot of good discussion about that, and just ensuring that the board and that management have a very strong crisis management strategy, I think is first and foremost as well. Other areas that were heavily discussed, I think, just on talent management, succession planning. There's a war for talent with the right skill set, and so being able to address that today. And then I think a lot of great discussions on technology, efficiencies with state-of-the-art technology, whether that is in how you are running your business and ensuring that you're able to get accurate data quickly and relevant to your management team so that they can make decisions and run the business, or whether that is interacting with your customers. We know that the state-of-the-art technology is where the customers are headed, and so needing to be able to think in that way to respond to the marketplace. So.
Scott?
I'd make the comment, building on what's just been said. We have a governance framework that depends on transparency and openness, but yet we also operate in a very interconnected global economy. And so with that, one needs to understand the risk associated with operating in an interconnected environment, but also to be able to have governance standards that apply to companies, particularly operating in regions around the world. And so I think as you look at those opportunities where certainly most companies are looking to invest in foreign markets, in emerging markets as a strategy for growth, be able to operate in a way that has governance and compliance that is ubiquitous across those operations is extremely important. And then ultimately understanding the risks associated with a lot of these regional developments is very important. We've seen that this year in terms of supply chain risk, customer risk. We're seeing that this week with companies that have certain exposure to things happening in China. Understanding this and having a global context is extremely important when making business decisions that impact growth and investment. And so I think that's the big takeaway for me as a director. But ultimately, in the context of optimism, maybe there's a little bit of a loosening where people should feel less constrained to be in holding on to capital and not making investments because we live in a risky world. That is the new normal. Mm-hmm. And directors and specifically corporations need to be able to operate in this new world, but take risk, and take risk knowingly.
Well, I can tell you it's always a pleasure to not only, Scott, have you report actually from Davos, but have the opportunity to do a recap. And Nichole, it's a pleasure to have you join us in your specialty area of global finance. So that will conclude this edition of This Week in the Boardroom. We hope you enjoyed the show. And we'll join us next week when we'll take a look at another critical topic that'll help you be a better board member or committee member. And we'll see you then.
Join us again next week for This Week in the Boardroom, brought to you by corporate board member and host NYSE Euronext, along with governance knowledge partners, the Center for Audit Quality and Grant Thornton, and contributing partners, National Investor Relations Institute and the Society of Corporate Secretaries and Governance Professionals.